We detected an unusual trade worth $1.1 million on Barrick Gold stock, ticker symbol GOLD. And what's also very unusual about this is that Barrick Gold reports earnings in a few weeks on February 12th. And so in this video, we will analyze this unusual option activity to find out if this wealthy investor is bullish and buying Barrick Gold before earnings or bearish and selling Barrick Gold before earnings. Because as we all know, the rich have more access to information, including leaked insider information, such as earnings reports, to make better financial decisions. No wonder the rich get richer. And so to level the playing field, let's dive into our analysis of unusual option activity. As we can see here on the options time and sales tape, 25,200 contracts and 2,800 contracts were being traded at the same time for these March 21st options at the 17 strike calls. And since these are the same options, we can add these together to get the total number of contracts being traded. 25,200 plus 2,800 contracts equals 28,000 contracts. And we can estimate the total trade costs by multiplying out the price that was being paid here, $41 each, because we have to multiply by 100 since each option represents 100 shares of stock. And so when we multiply by 41, we get a total trade cost of $1.1 million. But keep in mind, we have earnings coming up, and so this is a higher risk trade in comparison to the trades that we share on our website. And so if you want lower risk, higher probability of profit trades, then we'll put a link to our website at the top here where you can gain access to better trade ideas and trading strategies that further reduces risk while increasing the chance of profit. Because not all of these unusual trades will be profitable. Some will be a loss. But as long as we diversify with higher quality stock picks based on stronger data analysis, then we can become more profitable in the long term. Now, having said that, we still traded this even though this is a higher risk trade, but we use position sizing to manage our risk. We can see here for these March 21st options at the 17 strike calls, our position over here, POS stands for position, green means buy. And notice that the open interest is at 20,000 contracts, which is less than the 28,000 unusual options. So we know those were new opening trades and not closing trades. And that is why we also bought these for the $41 each, as we had just calculated earlier. And so when we analyze this trade, we can see here on the risk profile profit loss graph where the x-axis represents the share price of the stock, which is currently trading over here near $16 a share, and the y-axis represents profit loss. Note the zero break-even line, and so when the purple and blue lines are below it, it is a negative loss, and when it is above it, it is a positive gain, because this is a long bullish trade, and we can confirm it here on the Greeks. We have a positive delta trade. If it was a short bearish trade, it would be a negative delta. But keep in mind the risk on this trade, we have a negative theta. And so as time goes on, these options will decay in value. And that is why the break even shifts upward, where the stock needs to trade above $17.40 at expiration, which is represented on the blue line, for this trade to be profitable. The purple line represents the current date. And so if it does rally sooner, these call options could still be profitable even though it does not go above $17 a share. And so keep that in mind, and also the fact that this is a higher risk trade because we do have earnings coming up. If you want access to the lower risk, higher probability of profit trades, make sure to go to our website where we also share option strategies and stop losses if you only trade stocks to reduce risk while increasing the chance of profit. Let us know in the comments below. Do you think Barrick Gold will rise after earnings, or do you think it will crash down? As usual, please hit the like button, subscribe if you haven't, take care, and have a wonderful day.